good afternoon and welcome to MF Corner. I'm Sumera Abdi and with me is Kaustubh Belapurkar of Morningstar India, who joins in to advise all our mutual fund callers today. Hi Kaustubh, good afternoon and thanks for joining in. And you know, the one question on everyone's mind is that a lot of people have seen their portfolios get damaged and now they want to know how to repair it. So let's answer some of those queries. The first question today comes in from Mukul. Now Mukul Parashar has written to us from Madhya Pradesh and he has investments in several funds. I'm just going to read them out to you. He has a large cap Axis Blue Chip, Axis Focus 25. He has a Mira Asset Emerging Blue Chip, the Invesco Mid Cap Fund, the SBI Small Cap Fund, and currently he says he's investing about 45,000 via SIP into these funds for a time horizon of 10 to 15 years. So he says the approach that he has chosen for himself is moderately aggressive and he expects his portfolio to compound at a rate of 14 to 15%. Do you think he's on track for that?
So let me maybe start with that last point that you made about his expectation of returns. I think that's where we need to start tempering down expectations, because obviously we've had a great run of the markets, but 14-15% to my mind is a little on the aggressive side.
So he says he's moderately aggressive.
Yeah, that's true. But because a lot of investors they think they're aggressive, but the moment the market falls, then like we've seen the kind of carnage on the small and the mid cap side the last couple of years. So I just want to on the side of caution that a more realistic expectation would probably be in the lower double digits. I think that's a you can kind of start that as a baseline, if you have that long-term horizon. I mean, that's the first thing that I would kind of note. When I look at the funds, largely good. So I don't have any specific concerns about the funds that he's holding, but the one point that I would make is that while he's aggressive, if I look at the underlying holdings, I mean, he's got a mid-cap fund, he's got a small cap fund, he's got a large and mid-cap fund. So we just kind of break that portfolio down. Close to about 50% of his underlying stocks would be small and mid-caps. Now, to my mind, that's a fairly staggering exposure, even though if you have a fair bit of risk. I would typically tend to limit that in the 35 tops if it's a really young guy, going up to about 40%. Beyond that, I wouldn't really recommend. So that's one thing I would kind of urge him to look at and bring down. And the easiest way for him to do that is maybe add in a little bit of exposure to a large cap. A different large cap. Yeah, that's right. Because the other thing, obviously, given that he's got two Axis funds, which obviously there's a blue chip, which is a pure large cap strategy, and the Focus 25, it still does predominantly have a large cap exposure. There's a fair bit of similarity between the portfolios that they would run, the style that they were being run in. So I would definitely then bring in an element of what we call.
So you mean in addition to these two, you recommend a third large cap fund from another AMC?
Correct. That's right. So someone like a Mirai, the large cap, or the HDFC Top 100, which has got a much more value tilt to it, that will add an interesting style flavor, because that's the conversation that people have been having, that we've seen that polarized returns in stocks. So those high quality, high growth stocks have gone up, and Axis has been the ones that have been steadfastly following that sort of mandate for years now. So that's paying off for them, but you need to kind of diversify across fund manager styles also.
All right, that's a fair point. So Mukul, I hope that works for you. The next query comes to us from Sandeep Singh, and he's on the line with us from New Delhi. Hi Sandeep, good afternoon. How can we help you?
Yeah, hi Sumera. I just need to ask one thing. I have some FDRs with me. So I need to move those FDRs into equity or kind of mutual fund. So
okay.
Could you just help me out with just a good mutual fund which can give me decent returns for the period of 3-4 years?
Are you currently investing in mutual funds?
Yeah, I have some mutual funds in HDFC Midcap Opportunity Growth, and Canada Echo and Franklin Income. So
do you remember the schemes that you have?
Yeah. I don't remember the schemes. So
okay, I think I have your portfolio with me. You have the HDFC Midcap Opportunity, the Principal Emerging Blue Chip Fund, Canada Rebecca Emerging Equities, and the Franklin India Equity Growth Fund. So these are SIPs you've held on from 2012, 14, etc. Right? You now want to convert the fixed deposits that you have into lump sum or SIPs? What is
lump sum? Lump sum will be more beneficial, I believe. I have some 40 lakh rupees with me in FDR, so I need to move into mutual funds.
Okay, and what would you say is your risk profile? Are you young? You want to take risks?
I want to take kind of a more of a risk. Probably most of the portfolio is in FDR, 50-50 is in FDR. So I want to move from kind of a conservative portfolio to a kind of a higher risk. Yeah.
So he wants to jump from one extreme to another. Kaustubh, is there any question that you'd like to ask?
So the one question, Sandeep, I think you did touch upon it. Your time horizon, you said, is 3 to 4 years, right?
I want to buy a property in Delhi after 4-5 years. So FDRs are giving 5% returns, so 4% is after TDS.
Right.
So I probably 10-12% or 15% if there are good mutual funds.
Okay, sure. So, Sandeep, the first thing that I would do, given that, the time horizon that he has, clearly, we'll need to kind of build an asset allocation and, just be prudent, and err on the side of caution, given, it's a compressed time frame. I wouldn't tend to allocate more than, the funds that he has, more than 25 to 30% in equities. Largely built out of large cap funds, because, we've seen the kind of volatility that can come in small and mid cap. So 5 years is not a good enough time frame, and, 5 years is the tops that he's looking at. I clearly wouldn't want to get into that segment for him. So about 30% tops in large cap funds. The remaining would actually go into fixed income funds, which, on a post-tax basis would still make sense over a fixed deposit. The typical categories that I would tend to look at is short duration. We can add in some corporate bond funds, and if he is okay to take on a little bit of risk if the expectation high yields, some moderate credit risk funds, where they're ones that run not very high exposures to sort of single A's, but more sort of the AA exposures. We can potentially add them on to some of those.
Okay, and anything that you want to recommend in terms of specific schemes that he can pick up?
Absolutely. So if I look at the large cap side, the names that I would talk about, there's obviously the Mirae large cap, the HDFC top 100, the Birla frontline equity would be
similar advice to Mukul.
That's right. On the fixed income side, like I said, there's clearly you talk about on the short duration, there's the ICICI short term or the Kotak short term. Corporate bond funds is, I think, another very interesting space. Funds with really low expense ratio, so something like an HDFC corporate bond, or even the HDFC short term on the short duration side. The Birla corporate bond would be on that side. And if you want to look at the credit risk side, the names like an ICICI credit risk, for instance, a more moderate, or a Kotak credit risk on the more moderate credit risk side. But if you want something more aggressive, then something like a Franklin credit risk. But obviously, like I said, that does, like we've seen what's played out. Credit risk does come with its own challenges, and which you need to be aware of when you get into that sort of stuff.
Nimble these days.
Yeah, absolutely.
Okay, so Sandeep, that's the advice for you. I know there are many funds that have been mentioned, but I'm going to put the link up on Twitter so you can go through it again and get those names again. But one thing that I want to mention to you as well is you kept asking, is there a good mutual fund that you can recommend? Well, a lot of funds are good. There are many good mutual funds out there. What matters is that you choose the one according to your risk profile and that you keep it for a longer time horizon. So if you can push forward your time horizon, that would be ideal. 3 to 5 years is not the best time frame to actually judge the performance of a scheme in. But thanks very much and all the best for buying your house. The next query comes in from Ajinkya Gosavi. So he's written to us from Pune. He also has a portfolio already. He has a goal though. He wants to accumulate 1 crore rupees and he wants to do it in 15 years. So both sound reasonable. Let's see how his portfolio is. He has a Kotak Standard Multi-Cap, the Mirae Asset Emerging Blue Chip, ICICI Prudential Blue Chip, Mirae Asset Large Cap, and the DSP Mid Cap. Now cumulatively he's investing I think 6,000-7,000 rupees per month into these funds. One, is the selection of funds good enough, considering that he has 5 funds, do they fit well together? And secondly, do you think he can achieve his goal?
Okay, so let me start with the basic math behind the goal, right? So he's investing about 7,000 per month in an SIP right now, purely equity, and he's got a goal of 1 crore in 15 years. So if we do the math, clearly what he will need to do, and he'll have to actually be aggressive on 2 fronts. One is he'll have to keep continuing to step up his SIP amounts, and that's quite significantly, if you want to build an adequate buffer and actually get that 1.5 crores after 15 years, he will need to step it up by almost 25% every year. So that's one thing that he'll need to do, because otherwise the math just doesn't fit in. The other thing, given that obviously he's looking to kind of grow that that money over a 15-year period. I don't mind him adding on. So again, the funds that he's holding are great. There's no concern around that. But I don't mind him actually adding some mid-cap exposure, because he's got a sort of aggressive target in mind, and he's got a reasonable enough time frame to bump up that mid-cap exposure in his portfolio. Currently he's holding the DSP mid-cap. He can either augment his investment in that, or he can look at, say a fund like a Franklin India Prima fund, which are kind of also in the mid-cap space.
Okay, so Ajinkya, that's the advice for you, is that you need to step up your SIP, and what that means is that if you're doing SIPs this year of 7,000 rupees, and if the advice is that you have to step it up by 25%, which means that next year you would be needing to do SIPs of 7,000 plus whatever 1,700-1,800 rupees odd. So that would take your total SIP close to 9,000, and then in the second year it will be 9,000 plus another 25%. So that way 25% needs to be added to that year's investments. With that, we'll take a very quick break, come back in just a bit. There are lots more queries to answer, and our focus remains on mutual funds on the other side too. Stay tuned. Hi, welcome back. You're watching the MF Corner, and with me I have Kaustubh Belapurkar of Morningstar India, who's answering all the queries sent in today. So the next query comes in from Mridula Arya. So she's written to us from Bengaluru. I beg your pardon, he has investments in multiple funds. So let me just read them out for you. Currently, Mridula is investing about 90,000 rupees per month in the Mirae Asset Emerging Blue Chip. That seems to be a favorite today. Kotak Standard Multicap, Invesco India Contra Fund, SBI Small Cap, and the Franklin India Feeder US Opportunities Fund. Okay. Now the questions that Mridula has, one is that should the SIP into the Invesco India Contra Fund be stopped and move those funds to the Mirae Asset Emerging Blue Chip? As well, split the SIP into the SBI Small Cap with the Axis Small Cap. So basically diversify the small cap exposure as well. Now he says that he's not selected any pure large cap, mid cap because of the cyclical nature of the market. He is focused more on multi-cap funds. He does have one small cap, as the allocation in the other funds to small caps is quite negligible. So he's done a lot of work on his portfolio. As well, he wants to know, should he now add a focused fund? There's concentration risk, but then it also gives you the flavor of this generating alpha, and so what should he do now regards this portfolio? What are the changes that he requires?
Okay, sure. So let me maybe start the response to the multi-cap comment that he made, and then move on from there. Right. So now multi-cap funds, by their broad mandate, are obviously allowed to invest across capitalizations, but when we speak to most of the managers, those funds would tend to have soft mandates in place. So when I say that, there's a fund that will typically say that, okay, I'm now going to invest typically maybe like 60 to 80% into large caps and the remaining in the mid and small cap. So it's never going to be a scenario where a multi-cap fund, or at least most of them on the street, would say go to right down the curve and buy only 100% mid caps. Valuations are looking very, very, so they'll operate within those sort of ballpark figures. So in that sense, it's not like you're going to get a pure mid cap exposure out of buying a multi-cap fund and hoping that the manager does make that really, really dramatic shift. That's not something that's going to happen. So, and that's why when I look at his portfolio, I think the one thing, instead of maybe adding another small cap fund, the one recommendation I would make is that get that little bit of mid cap exposure by buying a pure mid cap fund. That's the one thing that I would do. To his other specific question about the Invesco Contra, should I switch that to the emerging blue chip? I think the Contra fund by itself is an interesting strategy. While I think though he's got about 20% exposure, maybe I might pair that to about 15%, but otherwise I don't see any reason to kind of completely move out of that fund, given that obviously you're looking at some bit of sort of contra undervalued strategies within that space, and Taya is obviously a great manager, so I don't really see a need to move out of that space altogether. The other thing again, and kudos is buying a US. I don't know when he bought that, but I'm hoping that he's been holding it for a while, because then he could have truly enjoyed the gains. And that's a point that not just to Mridula but to everyone, that you need to start having that global exposure. If you haven't already, do start looking at it. I know we have limited set of funds, but a US fund, which is a more broad-based sort of fund, would be a nice way to start off. At least like 10% of your portfolio would be a good place to start with. I think on the focus side, and if he's got, and it's an interesting position that we're in the market right now. Focused is gaining a lot of traction because your high conviction bets can really flow into the portfolio like that. So I don't mind him adding a little bit of focus strategy. So maybe the contra money that he's taking off, that 5%, can move into focus strategy. An Axis Focus 25 or a Franklin India Focus Fund would be the ones that I would ask him to look at.
Okay, and Mridula has asked a very interesting question about NFOs. Is that it may be a new fund,
right,
but the fund manager is not necessarily new. The fund manager has been there. Now, historically, we have said that if you have a choice between an NFO or an existing fund, go for an existing fund because you have a track record that you can refer. Even though you shouldn't just entirely look at past returns, but if you have a fund manager's good track record, why not an NFO?
Yeah, sure. So there are multiple ways of looking at it, right? So one is you think about the NFO and you think about what the manager's skill set is or his style is in terms of it doesn't match with the new fund offering that's coming in. I mean, in a classic cases, if he, if he's been more of a multi-cap guy or he's been more of a mid-cap guy, and today it's a multi-cap fund that he's going to be managing, and he's never done that or he's not really managed large assets in the past, in that kind of a style or a strategy, then you want to maybe just. He's a good manager, but he's done that in a slightly different style, so you don't understand that. But if it's something that he's been managing either around the asset management company or even within the contours not too far, then you could potentially look at it. But if you have other good managers that have existing track records already in place with strategies, then I'd still probably err on the side of caution and go with the one that's already existing. I know there's always that excitement of new. So you have to take it on a case-to-case basis. I can't make a blanket statement saying that NFOs are good or bad. It has to be really specific to the manager, the style of the fund, the manager's style, and then really take a call if it's worthwhile getting into that strategy or not.
Okay, Kaustubh, we're almost out of time now on the show, but there's a very interesting development that took place today, and I want to quiz you about it. Nitin Kamath, who is the founder and CEO of Zerodha, today announced on Twitter that they were planning to enter the AMC business and that he had already applied for a license. We've already seen a large distributor, that's NJ, get a AMC license. Now Zerodha looks set to at least enter should they get a license. What do you make of these moves? Could they cause the kind of disruption that they have caused in their respective businesses so far?
For one, I'm excited to see what they come up with, because clearly, they've, like you said, they've disrupted the stockbroking business, and now they have a pretty large investor base that's there, right? So in terms of having a segmentation of the investors that you want to get to, you already understand kind of their investing psychology in a way. I think it'll be interesting to see the way they go about it, and I think while it's because we've had kind of a top-heavy industry for a while, and I think someone coming and disrupting that in a way, competition is always good, right? And if they bring in positive change, then others would probably follow suit. So I'm quite excited to see what they bring.
And we've seen SBI overtake HDFC after years. Finally, somebody is overtaken in terms of assets, even though it was on a monthly closing basis. But nevertheless, it just goes to show that there's no room for complacency now, at least at the top. Kaustubh, thanks very much as always for joining in and for advising our viewers. We'll wrap up then on MF Corner, but do stay tuned in. The market action continues with closing bell on the other side.